Tony, but I guess most importantly, the automotive margins, right? Ex credit.
Yeah. Good morning, Carl. It was a terrific showing by Tesla. I think people were worried that ultimately margins would be pressured because of all the supply chain issues and inflation. And Tesla was able to increase margins by about 1% or 100 basis points on a sequential basis. So that was very reassuring. You know, Tesla's been able to do it through several ways. They've been effectively raising price, and because they don't have dealers, they're capturing those price increases, not a distribution partner. And, you know, they've done a very good job in terms of ramping capacity in their China facility where margins are higher. So most of the growth has been coming out of China. Margins there are better. And so the combination of those things led to very strong margin performance in the quarter.
So I doubt that GM and Ford, for example, are in your coverage universe. But if they were, would you expect them to try to adopt some of these efficiencies that are almost unique to Tesla? Or do you think they can try to close that gap given their own legacy models?
Well, I think, you know, that's really the challenge in any industry when you have a disruptive force. Everything is purpose-built and everything is new, and there's no structural legacy disadvantage. So, you know, in many ways, the dealership for traditional automakers has been an advantage historically. You know, right now, arguably, it's a disadvantage because it creates inventory. It allows for less pricing flexibility. And it's you know, it eats into profits. There is a cost of distribution. And much like Dell did 20 years ago by selling PCs direct, Tesla and other new EV upstarts have started that. So that's the challenge. You know, Tesla has all new factories. Tesla doesn't have a legacy dealer network. And those are disadvantages for the large auto incumbents today. Now, their scale brings some advantages, but, you know, that's the balancing act, is to try and leverage scale and customer relationships while being able to overcome the fact that their factories are not purpose-built for EVs, and they have a dealer network, which at times can be cost ineffective.
Right. So, Tony, everything I'm hearing from you, you continue to be impressed with the company's performance, but it's valuation where you get stuck and why you have an underweight rating on the company. So I wonder what kind of forward PE multiple would be appropriate for a Tesla. The company just made $3.3 billion on 310,000 units. What kind of growth are you factoring in over the next few years?
Sure. So you're right. Tesla's executing very well, and kudos to them for their performance. We do struggle with valuation. Tesla produces about 2% of last year, produced 1% of the world's cars, and had 50% of the total value of all car companies. So all other legacy car companies make 98% of cars, and yet they have the same value of Tesla, who produces 1% of cars.
So, Tony,
and so our concern really is about the ability to sustain a 50% growth rate, particularly since Tesla really only has 2 cars right now and doesn't have anything that's high volume that's planned. They have Cybertruck, but that will be expensive and lower volume. And they have, you know, what they talked about, a robo-taxi last night, but we're skeptical about Tesla's ability to deliver that by 2024, even 2025.